I want you to imagine for a moment that you started investing in 1985. For a couple of years, your money keeps going up and up until Black Monday. Up until this point, your friends probably thought you were some kind of genius, but now they're urging you to sell, but you ignore them. And slowly but surely, the market recovers until the dot-com bubble. Your friends are on their knees begging you to pull your money out, saying things like it's time to take your profits before you lose everything. Little did you know you are in for the ride of a lifetime until the housing crisis in 2008, the worst downturn since the Great Depression. Surely this is the end of the stock market, but as things reopened, the market soared 27% from its low, setting new records. What a comeback. The average return over this time period was 11.23% per year. So if you have only invested $250 per month during this time, then you would have made $1,841,521.08. That's a return of over 6,000%. Now that's the power of long investing. Let's jump into details. It's amazing how many people talk about investing but don't actually show you how to do it. Before you invest a single cent, you need a foundation, right? Because without it, one bad month can collapse everything you're trying to build. Step 1. Build your emergency fund. 3 to 6 months of living expenses sitting in a high-yield savings account. This is your safety net. It means you never have to sell your investments at the worst possible time just to cover rent. Step 2. Get proper insurance. Health, auto, home or renters. One catastrophic event without coverage can erase years of progress overnight. Step 3. Kill your high-interest debt. If you're carrying credit card balances at 20% interest, no investment in the world beats paying that off first. You cannot out-invest a 20% guaranteed loss. Once the foundation is solid, automate your money. A simple starting framework. 50% to needs, 30% to wants, 20% to savings and investing. The exact percentages are less important than the fact that it happens automatically before you can spend it. Set up an auto transfer the day you get paid and you'll stop missing the money within 2 months. You will never find the perfect moment to start. Not ever. The market will always feel uncertain. There will always be a reason to wait. So stop waiting. Start now. Just do it smart. Start small and be consistent. You don't need to dump your savings into the market on day one. Start with whatever amount won't keep you up at night. Maybe $50, maybe $500. What matters more than the amount is the habit. Consistent monthly investing beats one big lump sum sitting idle every single time. That's not opinion, it's math, and it has a name. Dollar cost averaging. You buy more shares when prices are low and fewer when they're high. Over time, it smooths out the volatility and works in your favor. An advice that has made ordinary people wealthy over generations. Don't try to pick winning stocks, not at the start. I know that's not what you want to hear. You want the next Tesla, the next Amazon. But even professional fund managers, people whose entire career is picking stocks, can't consistently beat the market. Most of them lose to it. Instead, start with S&P 500 index funds or ETFs. The S&P 500 is the 500 largest companies in America. Apple, Amazon, Microsoft, Google. When you buy an S&P 500 ETF, like Vanguard's VOO, you own a small piece of all 500 of them with a single purchase. You're not betting on one company, you're betting on the American economy. And over the last century, that bet has never lost over any 20-year period. Ever. This is literally the strategy Warren Buffett recommends for most people. Not stock picking, not market timing, just buying low-cost index funds and holding them for as long as possible. It's boring, that's exactly why it works. As you grow, you can expand. International stocks, individual companies you believe in, real estate. But when you're starting out, the S&P 500 is your foundation. Once your portfolio starts to grow, say $50,000 to $100,000, it's time to think bigger because different assets perform differently depending on what the economy's doing. When stocks crash, some other assets hold their value or even rise. Spreading across multiple asset types is what protects your wealth from any single storm. Real estate is one of the most powerful tools available. You put down a fraction of the purchase price, the bank funds the rest, and a tenant's rent covers your mortgage. Over time, the property appreciates in value. You're earning passive income and building equity simultaneously, two income streams from one investment. Commodities like gold and silver serve a different purpose. They're not wealth builders, they're wealth preservers. When inflation rises and the dollar loses purchasing power, these tend to go up. Think of them as insurance for the rest of your portfolio. As your wealth grows, don't keep everything in one place. Stocks, real estate, commodity, spread it around, and your portfolio can survive almost anything the market throws at it. A counterintuitive secret of long-term investing you should know. After you set everything up, the best move you can make is to stop moving. Automate your monthly contributions. Money flows from your paycheck into your brokerage account and automatically buys your index funds. You don't monitor it daily. You don't react to headlines. You don't touch it. Because the biggest threat to your wealth isn't a market crash, it's your own emotions. People panic sell when markets drop and lock in losses. They chase the hottest stocks when markets are soaring and buy at the peak. They constantly tinker, convinced they're being strategic. And they consistently underperform investors who did absolutely nothing. The best long-term investors are boring on purpose. Warren Buffett's preferred holding period is forever. He buys great investments and lets decades do the heavy lifting. Set the system. Trust the system. Let compound interest work quietly in the background. Your job is not to be active. Your job is to be patient. At some point, you're going to check your portfolio and feel sick. You'll see it's down 20%, 30%, maybe more. And everything in you will want to pull your money out. Don't. Market crashes are not anomalies. They are a normal, expected feature of investing. And more importantly, they are always temporary. When markets fall, stocks go on sale. The investors who got rich weren't the ones who ran. They were the ones who kept buying when everyone else was terrified. Stay calm. Keep investing. Panic gets punished. Patience gets paid. And that's the whole game. Long-term investing isn't complicated. It's just consistent. Build the foundation, automate the habit, diversify as you grow, and never let short-term fear kill long-term wealth. If this helped you, check out our next video and start today, not tomorrow. Today.